Hey everyone, welcome to the KE Report in a Daily Editorial on Tuesday, October 14th, chatting with Jim Tassoni. Jim is the CEO of Armor Wealth Strategies. We bring Jim on every month to talk about momentum trading. Jim is, let's call him our in-house momentum trader. And this month, we're going to be focusing on commodities because there are a lot of commodities that are making some very strong moves. Seems like precious metals really led the rally starting well over a year ago when gold started breaking out. And now silver's catching up. The stocks are catching up. But there's other precious metals that are doing well, like platinum, palladium. Copper's also doing well. Some of the energy metals are doing well, just not the energy, oil, and gas sectors. So, Jim, let's start off with I'm going to tie gold, silver, GDX, GDXJ, SIL. So that's the metals and the underlying ETFs that follow the stocks. You can really pull up any time frame chart, and the chart starts in the bottom left and runs to the top right. Clearly, momentum is very much on precious metals side, especially in the last couple months. How are you trading these right now?
Yeah, so and you're 100% right, Corey. I continue to, as probably would be expected by those who have heard me talk before and know that I tend to be a momentum style trader. You would expect me to be long most, if not all, of these metal type commodities. And fortunately, we are. So, lumping all of those together, we continue to see upside momentum to these names. Now, as we were discussing a little before we started the call here, we are now, as of Friday and heading into this week, I'm seeing an uptick in volatility. And with the VIX crossing above 1920 level here, that introduces a lot more what I've seen historically chop in some of these trades. So, one of the things that I want to be a little more cognizant of is maybe reducing position sizes, looking for places to take profits, maintaining these core positions as long as they don't violate my longer term trend levels, but being a little more selective in trimming and then adding as things pull back because I actually think, well, I'm still constructive on these markets as a whole heading into the back half of the year and even into the first part of next year. I think there'll be opportunities to take profits and then buy back at lower levels. I think we may see some more chop over the next few weeks or months.
Well, Jim, let's dig into that topic a little bit more. We've been talking with other guests about when to trim and what does a intermediate term or even a short-term topping period look like to you in something like the precious metals or the precious metals equities. Maybe put a little color on that because we've gotten some pushback from people saying, "Oh, why would you trim when it's going to $100 silver and $5,000 gold?" But there's going to be moves to the downside as well as the upside. So, how do you handle that part of it?
Yeah, and that's sort of when we get into a situation like this, I definitely expand out my risk ranges. I have levels both on the upside and the downside that I like to be able to either take profits, as you said, or add to because we will inevitably have pullbacks. I mean, the markets are never that easy, although it has seemed that way at times this year. It's never as easy as I'm just going to buy something and it's going to go up uninterrupted forever without any type of stagnation or pullback. So, for instance, in the gold market right now, we're looking at levels, up in this roughly kind of where we're trending up here right now in this 4160 area. I think this is potentially an area where if you're long a position, you may want to look to take a little bit off, not exit the position, but I think this is a healthy spot to, with the blow off top that we've had and this move higher, I think this is an area where you could trim your position. Look to add back. One of the areas that I would love to add back if we got down there, and I know it's a long way from here, but on the futures, I would love to get back in at the 38.95 area, which again seems far away, but in these more volatile markets, a couple 100 point move can happen pretty quickly. So I'm just looking to reduce risk right now, reduce positions as we're coming into a more volatile period. Being able to maintain the exposure, but reducing risk for me and my clients just makes sense because we've had a really good year, especially in these commodity markets. And we don't see any reason to give too much of it back if we are entering an era of more volatility. Now, if we see volatility subside, we could always make the decision to add back and go closer to our max positions again. But for now, we'll take it back to a closer to a minimum or equal weight position, if you will.
Okay, so that 38.95 level, about 5.5%, maybe lower than where gold is right now, almost 6%. So yeah, not much of a pullback when you consider just how much momentum gold has. But I feel like momentum sometimes is almost too simplistic because if a chart's heading up to the right, well, then momentum's on your side. If it's heading down to the right, well, then it's not on your side. What sort of loss of momentum would you look for other than a simple pullback that would tell you maybe that longer term or even midterm momentum to the upside has been lost and you truly change your strategy on a market?
Yeah, I think one of the things that I like to look for is when we get up into these areas that what I call kind of the top end of my range, if we continue to bump our heads against that and can't make a move through in a reasonable amount of time, depending on the market, be it 3, 5 days, whatever have you, if we continue to see a press up and a fail and a sort of stagnation, that's one thing that tells me that momentum may be waning a little bit here. And that's why I might look to take some off. But the biggest thing for me is, I've always been sort of a trim and trail kind of guy. So I have levels, like I said, where if we violate that level, I will get out of the trade. Even if it means I end up getting back in at a higher level, I'm kind of protect capital and then first, compound capital second. So we break certain levels. For instance, if we got down to that 38.95 level and I added and we didn't bounce and we ended up in a position where we closed below that, I'd probably scratch out of the trade or take a small loss on that position and look to enter again when momentum resumes. So I just like to sort of try to get into trades to trail that stop up as it works, trim if there's areas to trim, and watch price action for failure at key levels that I've identified.
Well, and Jim, taking it even one step further, at what point do you see a chart setup or a momentum setup change where you switch from trimming to hedging, where you may start shorting a market to the downside or at least putting on an inverse ETF or something like that?
Yeah, so for me again it's all about the levels. So I have sort of an intermediate term trend level that I use to determine the direction. So that's more of kind of a weekly chart, where I look at, okay, where are we on this chart? Where's the momentum? Are we above that key level or below it? And that will let me know, do I want to look for longs in this market or do I want to look for shorts? Then I'll switch more to kind of a daily chart from that point, and that will identify a little bit narrower range in terms of the levels. And that's what I use. So, for instance, on gold, obviously we have a very strong uptrending market. And for me, I mean, this will let you know kind of my longer term look at markets. Right now, if as long as we stay above 35.10 on the gold market, which is a significant pullback from here, I would not be looking to short this market. If we closed below 35.10 on a weekly, then I would flip to bearish and look for short setups. But as long as we're below above that, I'm going to be in one of two positions. I'm either going to be looking to establish, add, or trim longs, or moving out of the position and letting that sit in cash. I would not look to short this market because of the momentum until, at this point anyway, we got a break of that 35.10 level.
So, Jim, if we look at gold, silver, GDX, GDXJ, and SIL, are there any that stand out to you in terms of being more opportunistic, or are we just kind of in the same boat here for these main precious metals that it's just been a great market?
I mean, the charts all look somewhat similar to me in terms of just, there was those brief pullbacks, a little period of consolidation, and then this run up higher. And I mean, obviously, the silver market has been phenomenal, and we're really maintaining positions across all of the markets right now and have no reason besides a trim here and there to think about exiting these markets right now. One market that maybe hasn't participated as much, maybe partly because of the rhetoric coming out of Washington, D.C., but that we actually bought a position in today that I think maybe could have some room to the upside and some catch up, as opposed to maybe trying to chase if you didn't identify some of these other moves before, is in copper. And so we actually established a position in copper today down at that roughly 494 level. So far so good on that trade. That's an area where we wanted to get long. It had a longer term bullish trend for us. Short term, we had sort of an indeterminate chart, but we thought it got down to a level where it was interesting. And so that's sort of how we're looking at this. And maybe that's a position where you maybe could get some catch up or some upside as opposed to trying to chase some of these other metal markets that have just been rocket ships to the upside.
Well, with regards to copper, we've seen it bounce up above the $5 a pound range on the futures, maybe 3 to 4 times now, just over the last couple of years. But we did see that wild period because of the tariff news around the Trump administration was going to put tariffs on it, and then it turned out to only be on finished products, but not on copper. But it created a new range for copper where it got to like 560, and then it shot down to 430. So what would you do inside of that range with copper?
Yeah, so right now, I mean, my range is a little bit more narrow. I'm again trying to identify and thinking that we're moving into more of a choppy regime here, maybe for the next month or so, as we figure out where we're going to go into the final month of the year. My range on copper right now is, roughly 526 down all the way to 481. So, we took our position at 494. We'd hang on to this long until we violated that 481 level. So give it a little room to the downside. At 526, we would probably trim and trail. We'd take a little bit of profit at that level and look to continue to hold and maybe move our stops up a little bit. But that's sort of that range right now. I think we still got to clear that 526 level to make to start making a run at some of those higher, 545, 550, and then ultimately that 560 area that we had before the tariff talk.
So, with all this volatility in copper, is there any chance that copper breaks down, though? To me, it just seems like it's almost repriced post COVID, and the dips have been bought pretty quickly. There is still this kind of gradual upward momentum. Are you seeing any true downside risk?
100%. I think there's always a chance that something breaks down. I think that's why we have to have our levels identified when we go into a trade or a position. And for me, again, it's that kind of that 481 level on copper. We get below that, I am looking to exit the long and stay away from this trade. And then subsequently, where I would get ultimately, where I would flip to kind of a more bearish and look to short this would be more down in that 465 level. I think if we see a move and unable to hold kind of 465, because we had That flush all the way down, I think, on the tariff news, down to about 433 on the futures. But for me, we've got, 465 is the level, the line in the sand that I'm identifying. Below that, I would want to start looking for short setups. But 481 to 465 would be that sit on my hands. And as long as we're above 481, I'm gonna try to hang on to this long and see where we go.
Well, Jim, as far as the copper equities, there's about four ETFs now tracking it. The biggest one is COPX. It's kind of like the GDX of copper with the producers in it. Would you be interested in getting in that if you saw some momentum in copper itself? Because they don't always trade in tandem. The equities and the metals can sometimes diverge from one another, and sometimes COPX has held up a lot better than the copper price, and vice versa. So, any thoughts on copper equities?
Yeah, honestly, COPX was a missed trade for us. I mean, you can look at the chart. There was a definite breakout opportunity. Unfortunately, there's only so much capital and so many positions that you can put on. And also, from a risk mitigation standpoint, we also have to be careful. While we've loved commodities, we're as overweight as I've ever been in commodities in my 20 plus year career. I still had to be careful in terms of overweighting too much. When we've got platinum, palladium, uranium, we've got gold miners, silver miners. There's only so much capital to go around, but this has been a phenomenal trade. I mean, if I'm looking at this and if we could have bought on the breakout I'm just looking at my charts and my levels here that are through the algorithm that we have built. When we blasted through 4390 on this COPX, that was a definite confirmed breakout signal. And if only I had been smart enough to get in there, but you can't catch them all and sometimes you miss them. I don't know that I'd be chasing here.
What about uranium? Uranium stocks, I think, gave another great buying opportunity earlier this year. And boy, oh boy, those have also just taken off. And those are also, I think, very much on a general uptrend as well. So, what are you seeing in the uranium market?
Yeah, that's another one that's been a great trade for us. I mean, fortunately we may have missed COPX, but we caught we caught this one back in early May and we have pretty much been riding it and adding to it, trimming when we need to, but adding to it when we've had these pullbacks. And we had a nice pullback back in around August 20th that gave us a great chance to reload, put on a full position again after a good move. And we got long here again down in this 36.75 area, roughly mid-August, late August. Continue to ride it. We've got our stops now in at 47.66. I'm just looking at on this trade. And we're gonna continue to hold this as it moves higher, trim if there's an opportunity to trim, which we have done, but we continue to see upside in this, no real break in momentum or trend at this point. And this has been one of those that, there's been days where it's like, wow, maybe I should get out of this because there have been pullbacks, but like to your point, the pullbacks in this uranium market has been definitely a buying opportunity. As with most markets, actually, it's definitely been, since April, a buy every dip type mentality.
Well, Jim, let's talk about a area of the commodities that's not been like that, and that's oil and nat gas. They've been in the hurt locker really all year. How are you playing something like oil or nat gas?
Yeah, so we had a short on nat gas. We actually covered that. So that was a decent trade for us. Not anything that's going to make our year by any means, but a decent trade. We are still short crude oil. We think that this is just another one where it's almost been the opposite for us, where every little move higher has been met with selling pressure. And so we've really had a bearish overall look on oil dating all the way back to the middle of last year. We have not seen oil turn bullish on our longer term weekly trend indicator since all the way back in May of 2024. And so for us, it's been a situation where we have just been looking for short setups along the way. And our latest short setup triggered back on Monday, September 29th. We got at the close of that day, we got a short signal. We got short at 63.14 roughly. And we continue to be short here. We've got a stop up at 66.42. So definitely giving it some room, sizing accordingly. But it just continues to be a trade that for us, momentum is to the downside, and we just see this as every move there continues to be a leg lower, and here we go again, under 60, down in the 58.50 range.
So if we take a step back here, Jim, there are so many commodities that are doing really well. And I know you're simply a momentum trader, but do you have any crossover, any intermarket analysis that explains why energy, oil and gas in particular, is almost in a completely different trend than vast majority of the other commodity sectors?
Yeah, I mean, if I had to wager my very elementary analysis from a fundamental standpoint, I just think that there's the geopolitical setup, while you would think would be somewhat bullish with some of the turmoil, I think there's this complacency maybe that we are the United States has become a energy independent nation. We're not as reliant on Middle East reserves anymore, and every conflict that pops up in the Middle East seems to resolve itself. And I don't make light or make trivial of the lives that are lost in the conflicts or in the various events that have unfolded in the Middle East over the past few years, but nothing has escalated to the point where I think it really roils the oil and the energy markets. And so I think it's just a situation where prices just continue to trend lower because there's really no catalyst to trend them higher. Conversely, with the metals, I think there's a lot of thought that these are going to be needed for all types of new computing, quantum metrics. I think you've got the dollar that continues to move lower, a de-dollarization trend that people are trying to get in front of, which is more bullish for these precious metals and some of these commodities. So I think while there's a tailwind there, I think there's almost just more of a complacency or a lack of a catalyst to move the energy markets higher. And without a catalyst, I think they're almost beholden to just sort of drift lower to sideways. And that's obviously what we've seen.
Well, Jim, just to follow up on that on the energy space, one could make the point that with nuclear power getting so much attention from the big tech companies and with uranium doing well and pretty hot, it's the energy sector. It's just different than oil and gas. So maybe break down the dichotomy there. Is it because there's so many more executive orders from the Trump administration and more of a focus on big tech embracing it for the AI future versus you would think that nat gas would be doing well because it could also embrace the AI future and help with data centers. So why the divergence if one part of energy is doing great and another part's not?
Yeah, and I think that's a great point. And I think part of it, realistically, and it's what I talked about earlier with COPX, I think one of the things you also have to pay attention to is just simply capital flows. And we all know that money will flow to where it's treated best. And when you have all of these other markets vying for the attention of capital, you mentioned uranium, you mentioned all of these different, I guess I would call them alternative energy markets, sucking the life or the air out of some of these other markets. And so with everyone at some point has limited capital, and everyone wants to put that capital where they can get the best return on it. And there have been sort of just this move into, I mean, it's just continued. We've seen it broadening and gaining strength throughout the year in these precious metals, in these commodities across the board. Uranium is like you said, it's a really hot topic right now. It's a sexy trade. And so I think maybe it's getting a little bubblicious. I don't know. Time will tell. But at the end of the day, people want to go where they see the best opportunities. And right now, the capital is flowing to these other markets and away from your traditional energy markets. And it might just simply be that easy to figure out that we want to go where our money's treated best. We only have a limited amount of capital. And so we've been flowing it towards the markets that continue to impress us.
Well, there's a lot of impressing that's been done on the commodity side of things, and some of these have just gone vertical recently in some of the underlying equities. Boy, oh boy, a lot of money's been made this year, and so far still sounds like you're looking for continued momentum with the odd pullback, kind of just a natural bull market, it sounds like. We're going to follow up with you next month, though. Jim might get a little bit more into the equity markets, but thank you for taking some time with us to focus on a wide range of commodity markets, vast majority of them doing very well. If you want to follow along with Jim over at Armor Wealth Strategies, click the link in the show notes to find out what he's trading, what he's looking at. Jim, as always, thanks for your time today, buddy.
Thanks, guys. Have a good one.